What if I told you there was a simple switch that could control an entire country's economy? A single trade-off that let governments choose between more jobs or more stable prices. Well, for decades, economists thought they'd actually found it. It was this beautiful, simple idea, right up until it spectacularly failed and threw the world into chaos. This is the detective story of the Phillips Curve.
So let's start with the central puzzle, the big question. Can we have the best of both worlds? Can we actually get lots of jobs and stable prices all at the same time? For the better part of a century, this question has been right at the heart of economics. And the first simple answer came from a thing called the Phillips Curve. Our story really kicks off back in the 1950s. An economist discovers what looks like a fundamental law of economics, this simple, almost elegant, predictable relationship between inflation and unemployment. So here's the core idea, and it's named after the economist A.W. Phillips. What he found looked like a law of nature. Unemployment and inflation just seemed to move in opposite directions. So when more people had jobs, prices tended to creep up. And when more people were out of work, price increases would slow right down. And this curve right here shows that trade-off perfectly. I mean, just imagine you're a policymaker for a second. You could aim for point B, right? Low unemployment at 3%, which sounds great, but you'd have to accept higher inflation of 5%. Or you could go for point A to get inflation down to a nice, comfortable 2%, but the price you'd pay would be higher unemployment, maybe closer to 6%. It was like a clear menu of choices. Now, this wasn't just some dusty academic theory for very long. In the boom years of the 50s and 60s, governments looked at this and saw a revolutionary new tool for actually managing the economy. All of a sudden, economics seemed to offer this menu of options. Did the government want to really push for job growth, even if it meant prices rose a bit? Or was the main goal to keep inflation under control, even if the job market got tougher? Using their main tools, fiscal policy, which is just government spending and taxes, and monetary policy, which is managing interest rates, they really believed they could just pick their spot on the curve. So, what was the logic behind it all? Well, think of it like this. When the government stimulates the economy, let's say by spending a bunch more money, it boosts the overall demand for everything. So to meet that new demand, companies have to produce more. And to do that, they have to hire more people. That's great. Unemployment goes down. But as everybody starts buying more and the economy heats up, businesses can start raising their prices. More jobs, but higher inflation. That is the trade-off in action. And for about 20 years, this model seemed to work like a charm. It was kind of the golden age of this type of economic thinking. But then came a crisis that just shattered this comfortable reality and threw the entire field of economics into total chaos. The 1970s. A decade of oil shocks, huge economic turmoil, and a strange new problem that, according to the simple Phillips curve, really shouldn't have been possible at all. The world got introduced to a new, pretty ugly word, stagflation. This was this toxic combination of economic stagnation, which just means high unemployment, and high inflation all happening at the exact same time. The trade-off was gone. The curve was officially broken. I mean, you literally got the worst of both worlds. Prices were skyrocketing, squeezing every household's budget, but people were also losing their jobs. That whole menu of options was gone, and it was replaced with a crisis that the economic model of the day just could not explain. So out of all the chaos of the 1970s, a really powerful counter-argument started to emerge, led by economists like Milton Friedman. They had a brand new explanation for what was going on, and it was one that would change economics forever. The monetary's big insight, the real game changer, was this distinction between the short run and the long run. They said, yeah, sure, a government might be able to temporarily create more jobs with a jolt of stimulus. But here's the catch. It only works as long as the inflation that comes with it is a surprise. The second people start to expect it, the magic is gone. In the long run, they argued, there's no trade-off at all. Their model looks completely different. It's just a vertical line. Now, this was a radical idea. It represents what's called the natural rate of unemployment. You can think of it as a baseline level that's set by real structural things in the economy. And the argument was that you just can't push unemployment below this line for very long. Pumping up inflation to 5% or 10% or whatever won't change that basic reality. The economy will always snap back to that natural rate. This quote just captures their whole critique perfectly. Trying to use stimulus to permanently keep unemployment below its natural rate? It's a fool's errand. All you're going to get for your trouble is higher and higher and higher inflation, without any real lasting gains in jobs.
Okay, so how does this actually happen?
Well, the secret ingredient here is expectations. Just follow the curve with me. Initially, a government stimulus might move the economy from point A to point B, lowering unemployment. Great, it works for a little bit. But then people start to notice prices are going up everywhere. They start expecting inflation. So what do? They demand higher wages to keep up. This raises costs for businesses, which then stops them from hiring. And the result? The entire trade-off curve shifts upward. We end up at point C, right back at the same natural unemployment rate, but now we're stuck with higher inflation. The government tries again, and you just keep climbing this ladder to nowhere. So this debate from the 1970s, it isn't just history. It fundamentally reshaped how central banks and governments think about the economy. And you can still hear its echoes in policy debates happening right now.
And that really brings us to the two big schools of thought that dominate today. The monetarist view, on one hand, says unemployment is mostly a supply-side problem. Think of it like the labor market has clogged pipes. The solution isn't to just pump more water or stimulus through, it's to fix the pipes. The modern Keynesian view agrees about the pipes, but says, hey, during a huge crisis, the problem can be demand deficient. There's simply not enough water in the system to begin with. In that specific case, a little bit of stimulus can get things flowing again.
So the whole debate today kind of boils down to this. When we see unemployment start to rise, what's the real cause? Is it a deep structural problem with the workforce that stimulus just can't fix? Or is it a simple lack of demand that stimulus can fix? How policymakers answer that question literally determines whether they hit the brakes or slam on the accelerator during an economic crisis.
And that leaves us with a final thought. Our understanding of the economy is built on these models, but the story of the Phillips curve shows that those models can break. The stagflation of the 1970s was a shock that nobody saw coming. It really makes you wonder, what's the next shock out there that will force us to tear up the rulebook and start all over again?